Heikin-Ashi technique. The Heikin-Ashi technique averages price data to create a Japanese candlestick chart that filters out market noise. Heikin-Ashi charts, developed by Munehisa Homa in the 1700s, share some characteristics with standard candlestick charts but differ based on the values used to create each candle. Instead of using the open, high, low, and close like standard candlestick charts, the Heikin-Ashi technique uses a modified formula based on 2-period averages. This gives the chart a smoother appearance, making it easier to spot trends and reversals, but also obscures gaps in some price data. The formula for the Heikin-Ashi technique is: the Heikin-Ashi technique is used by technical traders to identify a given trend more easily. Hollow green candles with no lower shadows are used to signal a strong uptrend, while filled red candles with no upper shadow are used to identify a strong downtrend. Reversal candlesticks using the Heikin-Ashi technique are similar to traditional candlestick reversal patterns. They have small bodies and long upper and lower shadows. There are no gaps on a Heikin-Ashi chart as the current candle is calculated using information from the previous candle. Benefits of Heikin-Ashi. Because the Heikin-Ashi technique smooths price information over 2 periods, it makes trends, price patterns, and reversal points easier to spot. Candles on a traditional candlestick chart frequently change from up to down, which can make them difficult to interpret. Heikin-Ashi charts typically have more consecutive colored candles, helping traders to identify past price movements easily. The Heikin-Ashi technique reduces false trading signals in sideways and choppy markets to help traders avoid placing trades during these times. For example, instead of getting 2 false reversal candles before a trend commences, a trader who uses the Heikin-Ashi technique is likely only to receive a valid signal. Limitations of the Heikin-Ashi. Since the Heikin-Ashi technique uses price information from 2 periods, a trade setup takes longer to develop. Usually, this is not an issue for swing traders who have time to let their trades play out. However, day traders who need to exploit quick price moves may find Heikin-Ashi charts are not responsive enough to be useful. The average data also obscures important price information. Daily closing prices are considered important by many traders, yet the actual daily closing price is not seen on a Heikin-Ashi chart. The trader only sees the averaged HA closing value. In order to control risk, it is important the trader is aware of the actual price, and not just the HA average values. Another important element in technical analysis that is missing from the Heikin-Ashi charts is price gaps. Many traders use gaps for analyzing price momentum, setting stop-loss levels, or triggering entries. How to use Heikin-Ashi candlesticks. Heikin-Ashi charts can be applied to any market, and most charting platforms now have them included as a functionality. There are 5 primary signals that identify trends and buying opportunities. Hollow or green candles with no lower shadows indicate a strong uptrend. Let your profits ride. Hollow or green candles signify an uptrend. You might want to add to your long position and exit short positions. Candles with a small body surrounded by upper and lower shadows indicate a trend change. Risk-loving traders might buy or sell here, while others will wait for confirmation before going long or short. Filled or red candles indicate a downtrend. You might want to add to your short position and exit long positions. Filled or red candles with no higher shadows identify a strong downtrend. Stay short until there's a change in trend. These signals may make locating trends or trading opportunities easier than with traditional candlesticks. The trends are not interrupted by false signals as often and are thus more easily spotted.